A common misconception about HUD's multifamily loan programs, like the 223F program or the 221D4 program, is that when you think of HUD, you think of low-income housing, affordable housing. You assume that a property has to have some sort of affordability component in order to qualify for one of these loans. And that's not the case. You can have an apartment building that's 100% unrestricted, 100% luxury, no rent ceilings imposed whatsoever. HUD does, however, have some definitions for affordable housing that you, as a property owner or developer, can voluntarily elect to pursue. And if you pursue those affordable housing definitions, there are some incentives in underwriting that can actually help overall loan proceeds. This video will define the three definitions HUD has for affordable housing. The first, is seen here, number one, is based upon area median income. If you've ever explored low-income housing tax credits or LIHTC, you might be familiar with that term. I'm not going to get into the details of area median income. In the description of this video, I'll include a link to a calculator where you can plug in your project's location and it will generate what the AMI rents are for that area and how that relates to this percentage. So what HUD's looking for is that 20% of the units of the project have rents that are no greater than what would be affordable at 50% of area median income, or 40% of units at 60% of area median income. You can imagine different pockets of the country. Some pockets have higher income, some have lower. So we're trying to back into a rent level that can be supported relative to income. And then when you have a studio, one bedroom, two bedroom, three bedroom, there's an assumption in the rent calculation that a higher bedroom count will have more tenants in the physical unit, so they will have more income, thus you have a higher rent. So the studio is going to have a different ceiling than a one bedroom, two bedroom, or a three bedroom. And it's not just enough to say that you're going to be imposing these percentages based upon AMI. The actual enforcement of that has to be in place for at least 15 years post-closing, whether it's a 223F, 221D4, or any HUD multifamily loan. You need to have an independent agency review that each year to make sure that you are actually enforcing those rent restrictions. Typically, the independent agency is just a housing authority or some sort of local form of governance. You'll also note that the underwritten rents also need to have a discount below market, 10% below market. So if you're in a market that has economic challenges and rents are kind of naturally low, they're naturally at these levels here, 60%, 50% AMI, HUD's going to want to see a further kind of haircut on the rents that you're charging to tenants to prove that it truly is affordable housing. The other way to qualify as affordable housing under HUD is if you have a long-term project-based Section 8 HAP contract. Project-based means it's a HAP contract that's tied to the asset. It's not vouchers that a tenant can take and bring somewhere else. It's tied to the property. HUD wants to see that Section 8 contract with at least 15 years remaining, and it needs to cover at least 90% of the units. So what is the net impact? What's the ripple effect of that on underwriting? Well, here's a matrix. You don't need to worry about the percentages too much. Like, cost is related to HUD's construction programs, values related to refinance. It's not worth getting into the minutia for the purposes of this video. Just know that in a market rate scenario, no affordability whatsoever, we're at 87% leverage, a 115 debt coverage ratio, and we underwrite with a 7% vacancy factor. If you qualify as affordable per definition 1 here, the AMI restrictions, you go from 87% 115.7 to 90 111.5. And if you qualify as 90% Section 8 under definition 2 here, that goes to 90% leverage, 111 debt coverage ratio, and we can underwrite down to a 3% vacancy factor. It should be noted that regardless of affordability, market, affordable, all Section 8, 90% Section 8, in a cash out refinance, the value constraint when we're determining the mortgage is always going to be 80%. And lastly, there is a new definition that HUD has for affordable housing. It's only applicable to the 221D4 new construction or rehab program. So only applicable to the 221D4 program. Essentially, if you restrict the rents of the project to 120% AMI and you impose that restriction to 50% of the units for at least 10 years, we can underwrite with higher loan to cost and a lower debt coverage ratio. So a 221D4 on the market rate side would go from 87 115 7% to 90% 111 7%. You might say, what is the material difference there? What does it mean 120% AMI? Well, this is actually a very powerful option because in many cases 120% AMI is essentially market. Your 120% AMI ceiling for a one bedroom apartment in a strong market might be $3,000 technically on paper, but you might only realistically be able to charge a tenant $2,000 or $1,500, whatever the case may be. So you don't have to take a haircut in revenue but you're still getting an increase in your loan basis, which helps reduce overall equity. So I hope this video was helpful. It's just a brief overview. I'm always happy to dig into the details on a specific scenario. Reach out, call, email anytime. Thank you for watching.